Good afternoon. Today we're going to discuss Chapter 5, which is entitled Audit Evidence and Documentation. In this chapter, we'll discuss the relationship between audit risk, audit evidence, and financial statement assertions, the appropriateness of audit evidence, audit procedures, data analytics, and audit documentation. So moving into audit risk, the possibility that the auditors may unknowingly fail to appropriately modify their opinion on financial statements that are materially misstated. This is the risk that the auditors will issue an unqualified opinion on financial statements that obtain a material departure from GAAP. So auditors must obtain sufficient appropriate audit evidence to reduce audit risk to a low level in every audit. And so as a review, this brings us back to Chapter 1, where we discuss the different types of forms of attestations. And so an audit would fall under the type of engagement as an examination. Again, that would have a level of assurance that is very high. The risk material misstatement should be low. And for procedures, they select from all available procedures any combination that can limit attestation risk to a low level. And so this diagram we used in prior to discuss an audit of a subject matter, and in this situation it's the financial statements. And so you'll have management that will make some assertions on the financials that they prepared, and then you have the auditors that will come in and assess this using some type of criteria. In this situation is GAAP. They'll gather evidence and issue a report and an opinion. And so financial statement assertions. And so relevant assertions are those that without regard for control have a reasonable possibility of containing a material misstatement. An assertion is a statement of fact or belief by management. And so some of these assertions are about account balances, they're about classes of transactions and events, and the presentation and disclosures. And so according to the Auditing Standards Board and internal standards, these are different types of situations that need to be assessed for the assertions made by management. And so you have accounts, you have transactions and disclosures. So with accounts, you will look at the existence of whether or not they really exist, rights and obligations, completeness, and valuation and allocation. Transactions, again, the occurrence, completeness, accuracy, cutoff, and classification. And for disclosures, you have occurrence, rights and obligations, completeness, accuracy and valuation, and classification and understandability. And so to further explain those, per your text, the existence or occurrence, assets and liabilities and equity interests exist and recorded transactions have actually occurred. Rights and obligations, the company holds the rights to the assets, while liabilities are the obligation of the company. Verify those. Completeness, all assets, liabilities, equity interest, and transactions that should have been recorded are recorded. Cutoff, transactions and events have been recorded in the correct accounting period. Valuations, allocations, and accuracy will determine whether all transactions, assets, liabilities, and equity interests are included in the financial statements at proper amounts. And your presentation and disclosure. Accounts are described and classified in accordance with generally accepted accounting principles, GAAP, and financial statement disclosures are complete, appropriate, and clearly expressed. So audit risk can be viewed as the risk of material misstatement and the risk of auditors fail to detect material misstatements equal your audit risk. And so here the risk of material misstatements include inherent risk and control risk, while your risk of audit fail to detect material misstatements is your detection risk. And so an inherent risk is a risk of material misstatement occurrence in an assertion assuming no related internal controls. So this is before you get to your internal controls. Control risk is a risk that material misstatements in an assertion will not be prevented or detected on a timely basis by the company's internal controls. So something that gets past the internal controls. Detection risk, the risk that auditors' procedures will lead them to conclude that a material misstatement does not exist in an assertion when in fact such misstatement does exist. So something that gets past the detection risk. And so here, audit risk is displayed as a formula. Your audit risk is your inherent risk times your control risk times your detection risk. And again, detection risk is dealing with the audit and the auditors, and your inherent risk and your control risk are management's responsibility. And so audit risk figure 5.2 is a very good diagram that you should include in your notes to describe the situation when it comes to audit risk. And so again, audit risk includes the risk of material misstatement and the detection of material misstatement risk. And so in the risk of material misstatement, you have an inherent risk and a control risk, and the auditor's risk of detecting material misstatement is considered detection risk, and it gives you your audit risk. So here they give an example of a bag of sand. So a bag of sand can have a hole in it and it's leaking sand. And so that's your inherent risk, is the fact that you could be losing sand. Sand represents transactions that may not have the right valuation, the right year, any kind of issues in your financial statement, transactions or accounts. And so misstatements are likely to occur in the client's financial statements. That represents the sand leaking. Now, the first level of defense are your control risks. Misstatements prevented or detected by control. So you have internal controls that may catch some of these issues so you can address them. But some of those issues still get by the internal control process. And so that's when you have misstatements that bypass the client's controls. These misstatements are detected by the auditor's procedures. And so the auditors will pull samples, they will look at material, and they'll do another assessment. And so the items that get past the auditor's procedures are misstatements undetected by the auditor. And so as an example for this, let's say it's accounts payable dealing with paying your vendors. The inherent risk is you could have the wrong amounts. You can pay them the wrong amounts. You can put the wrong contact information on a check. Your control risk, the system normally checks for amounts. It compares invoices to checks. You may have an individual with office flows where someone else is checking these items, addresses, things of that nature at different levels. Those are your control risk. Then the items that get past the control risk, the auditors will ask for a sample. They will pull certain checks based on the industry, again, things dealing with risk, to determine what they want to look at. And they may find when they're reviewing these items that there is an error in the dollar amount, the invoice, the date, the mailing address. And so those are issues that need to be corrected at that point. But then there's still some issues that they didn't pull in their sample that may still get by everyone. And those are considered your audit risk. So inherent risk, again, factors that affect inherent risk are the nature of the client and its environment, the nature of a particular financial statement element. Business characteristics indicate indicative of high inherent risk. So inconsistent profitability of client, operating results highly sensitive to economic factors, going concern, large misstatements declared in prior audits, and substantial turnover, questionable reputation, inadequate accounting skills of the accounting department. One of the examples I want to point out here when they're discussing the nature of the particular financial statement element, there's a lot larger inherent risk when you're dealing with cash as opposed to a deposit that's made with a check. So that would give an example that would probably draw more interest if you're dealing with cash. So assertions with high inherent risk, they involve difficult to audit transactions or balances, complex calculations, difficult accounting issues, significant judgment by management, and valuations that vary significantly based on economic factors. And so the types of transactions, you have routine, non-routine, and estimations. And so routine, so recurring financial statement activities recorded in accounting records in a normal course of business have lower inherent risk. They're repetitive. Someone is entering them all the time. They've kind of been flushed out and the errors have kind of been found. Non-routine things involve activities that occur only periodically, such as the taking of physical inventory. It has a high inherent risk because it's something you're only doing once a year. So it should be reviewed. And then again, estimations. So estimations and transactions, activities that create accounting estimates, they're higher inherent risk because they're dealing a lot more with judgment, so they should be reviewed. So the appropriateness of audit evidence. And so auditor must obtain sufficient appropriate audit evidence. And so to be appropriate audit evidence must be relevant and reliable. And so audit evidence is ordinarily more reliable when it is obtained from a knowledgeable independent source outside of the company. Again, we're dealing with that independence rather than non-independent sources. Generally internally through a system of effective controls rather than an ineffective control. So they don't want documentation from a system that controls are not implemented well or followed well. obtained directly by the auditor rather than indirectly or by inference, documentary in form rather than oral, and then provided by original documents rather than copies. So overall categories of audit procedures. So you have risk assessment procedures, and then you have some further audit procedures. Your risk assessment procedures are designed to obtain an understanding of the client and its environment, including its internal control, to assess the risk of material misstatement. So further audit procedures are your test of controls and substantive procedures. And so test of controls, when appropriate, to test the operating effectiveness of controls and preventing material misstatements. And substantive procedures are to detect material statements that at relevant assertion level. Substantive procedures include analytical procedures, test of details of account balances, transactions, and disclosures. So types of procedures. So you have an inspection of records and documents, inquiry of knowledge of persons within or outside the entity, external confirmation, like with banks, loan, and then vendors, inspection of tangible assets, inventory count, observation of process or procedures being performed by others. So normally they will walk through or watch you receipt something or watch you produce a check or run a payroll. Recalculation of mathematical accuracy, uh, performance of procedures, and additional analytical procedures. So here we have a schedule of audit procedures and examples. And so the audit procedures consist of an inspection of records, inquiries, external confirmations, inspection of intangible assets, observations, recalculations, reperformance, analytical procedures, and scanning. And so, as an example, an inspection of records and documents, you would inspect certain records as evidence of ownership, a test of controls to inspect records for evidence of proper authorization. External confirmation consists of confirmation of accounts receivable. So this is a very good chart to use for your notes. We move to substantive procedures. Again, they include analytical procedures, test of details. So these tests are of account balances, classes of transactions, and disclosures. And so one may change the scope of the audit by adjusting the NTE, which is the nature, timing, and extent. The nature being the type or form, timing when preferred, performed, and extent the quality of evidence obtained. So nature and timing of procedures. So holding the extent of the procedures constant, one may increase the scope of procedures by either changing the nature, obtain more reliable evidence, or the timing, wait until the year end to obtain evidence from an entire set of transactions rather than pulling the information too much prior to the year end and just updating. So the extent of procedures, holding other factors such as the nature and timing of procedures constant, the greater risk of material misstatement, the greater the need extent of substantive procedures. So the main way to increase the extent of audit procedures is to examine more items. And so the sample size should reduce detection risk so as to restrict audit risk to a low level. Analytical procedures, the steps involved in that process are developing to develop an expectation of amount or balance, determine amount of difference that can be accepted without investigation, compare the company's account with expectation, and investigate and evaluate significant differences. And so developing an expectation, so you should look at prior period information, anticipated results, relationship among elements of financial information within a period, industry information, and relationship between financial information and relevant non-financial data. So types of expectations, you have trend analysis and ratio analysis. And so with a trend analysis changes, analyzes change in accounts of a company over time. And a ratio analysis compares relationship between two or more financial statement accounts or comparison of account balances to non-financial data. They look at liquidity, leverage, profitability, and activity, which deals with your current ratio, debt, equity, gross profit percentage, and inventory turnover. So ratio analysis, approach to ratio analysis, you have your horizontal, cross-sectional, and vertical. Horizontal analysis reviews ratios over time. Cross-sectional analysis analyze ratio of similar firms at a point in time. And vertical analysis analyze relationship within a period Use common statements if prepared. And so common size financial statements are statements that present each amount as a percentage of some financial basis. So comparing what is the expenditure as relates to a percentage of sales. And so then you have other methods, which are regression analysis and reasonableness tests. So identifying potential misstatements, you have in this figure here, you have your analytical procedures and then the potential misstatement that you're reviewing. So if you look at comparison of inventory levels for the current year to those of the prior year, that's dealing with misstatement of inventory obsolescence, comparison of research and development expense to a budget. So misclassification of research and development expenses, comparison of accounts receivable turnover for the current year to that of the prior year. And so that's dealing with misstatement of sales or accounts receivable, misstatement of allowance for uncollectible accounts, comparison to the client's profit percentage to published industry averages, misstatement of sales, accounts receivable, misstatement of cost of goods sold and inventory, comparison of production records and units to sales. And so that's a misstatement of sales or misstatement of inventory. And then comparison of interest expense to the average outstanding balance of interest-bearing debt. And so that could be an understatement of liabilities, a misstatement of interest expense. So journal entries on the effects of journal entries on ratios. And so ratios are very important and they're used in the audit to determine to look at risk. And so here, this is an illustration of how a transaction can adjust a ratio dramatically. So on December 31st, they have a sales credit, and then they determine whether it's a real or fraudulent entry because of the fact that prior to this entry, the ratio of sales to AR was a 7. And after the entry, which was $50,000, it adjusted that ratio to a 5. And so it had a huge impact. Again, similar, this is a cash sale. Same thing happened. There was a transaction of December 31st. And so from that transaction, your ratio change went from a 7 to a 7.5. And so here, again, they're looking at the huge effect it made on the change. So the effect of changes in numerators and denominators of ratios greater than 0. And so increasing the numerator of a ratio always increases the ratio. Increasing the denominator of the ratio always decreases the ratio. And so when you increasing the numerator and denominator of a ratio by the same amount, if the ratio is greater than 1, it decreases it. And if it's less than 1, it'll increase it. And so given that situation and then the two previous adjustments that were made based on a sale and a credit sale at the end of the year, it makes it clear that you have to be very careful when analyzing ratios during the audit. So data analytics. Data analytics is the process of using related and unrelated data sets to provide insights into decisions. It's highly used by auditors. So CPA firms are increasingly using data analytic approaches to improve risk assessment tests of control and substantive procedures. Basic approach to auditing accounting estimates. So auditors make sure to review and test management process for developing the estimate, independently develop an estimate to compare to management's estimate, and review subsequent events or transactions bearing an estimate. Auditing fair values. So inputs to use in applying valuation techniques, three levels. Inputs of observable quoted prices in active markets for identical assets and liabilities. Inputs of observable quoted prices generally or similar assets or liabilities in active markets, and inputs that are unobservable for the assets or liability, dealing with private companies. Related party transactions. Disclosure requirements must be met. The primary challenge is identifying undisclosed related party transactions. And so they need to make inquiries of management, review SEC filings, stockholder listings, and conflict of interest statements, and then be alert for transactions with related parties and any transactions with unusual terms. So functions of audit documentation. And so there's a primary function and secondary. The primary functions of audit documentations are to support the auditor's compliance with auditing standards and support the auditor's opinion. Secondary functions are assist continuing in new audit team members in planning and performing the audit, serve as a record of matters of continued audit interest, assist in supervision and review of the audit, demonstrate the accountability of team members, and assist in internal reviews, external peer reviews, PCOB inspectors, and successor auditors in performing their roles. Sufficiency of audit documentation. So audit documentation should be sufficient to enable an experienced auditor to understand the work performed and significant conclusions reached, identify who performed the work and reviewed the work, show that accounting agree or reconcile to the financial statements. Audit documentation should include all significant findings and the actions taken to address them. So the types of working papers. You have audit, administrative working papers, working trial balance, a lead schedules, adjusting journal entries and reclassification entries, supporting schedules, analysis of ledger account, reconciliations, computational work papers, and corroborating documents. So the types of working files that auditors keep, they have current files and permanent files. The current files are the current year working papers, index and cross-referencing system. And permanent files are items of continued audit interest on a particular client. In this example, you have an example of organization of current files. And so you have financial statements, your working trial balance, any adjusting and reclassification entries that are on the cash lead sheet, and then your other cash sheets, confirmations, and reconciliations that follow. This is an example of a working paper. And so on a working paper, you typically have a header. You'll have the preparer's initials and the date, the reviewer's initials and date, the index for the cross-referencing purposes, tick marks that are normally identified by the firm they're using, and then you have the auditor's conclusions normally on this form. In summary, we have gone over the audit risk, the relationship between audit risk, audit evidence, and financial statement assertions, the appropriateness of audit evidence, audit procedures, the data analytics, and audit documentation. So please reread this chapter and review the PowerPoint again. Thank you.